Welcome to Deep Dive into Finance channel, your go-to place for all things finance. Today, we're opening the book on a fascinating topic, bootstrapping in finance. Now, you might be familiar with the term bootstrapping in the context of startups, but it carries a different meaning when it comes to finance. Here, it is a statistical method used to estimate the sampling distribution of a statistic. Think of it as a tool that allows us to create a multitude of alternate universes from a single data set. This technique is incredibly versatile and finds its use in various areas of finance, including the testing of the stability of financial models. It helps us assess how robust a particular model is by generating numerous scenarios and testing how the model performs under each. Now that you have a basic understanding of what bootstrapping is, let's delve deeper into its applications in finance. Bootstrapping plays a significant role in financial modeling. As we delve deeper into this topic, let's consider the role of bootstrapping in this context. Financial modeling is about creating a representation of a financial situation, typically to forecast future financial performance. It can be likened to constructing a miniature version of a real-world scenario. Now imagine constructing this model without having all the pieces in place. This is where bootstrapping comes in. Bootstrapping, in the realm of financial modeling, is a powerful statistical tool that allows us to test the stability of a model. It involves creating a large number of resamples of the original dataset, each of which is used to construct a new model. This process allows us to simulate a range of possible outcomes and examine how the model performs under these various conditions. But why is this so important? Well, the world of finance is filled with uncertainty. Market conditions can change rapidly, and a model that seems perfectly accurate today may not hold up tomorrow. Bootstrapping helps us understand the accuracy of our model in the face of this uncertainty, allowing us to make necessary adjustments. Imagine you're a financial analyst tasked with forecasting a company's future earnings. You've built a model based on available historical data, but you're aware that the future is unpredictable. By using bootstrapping, you can create a range of potential future scenarios and see how your model performs. This not only helps you gauge the accuracy of your model, but also equips you with insights to make necessary tweaks. In essence, bootstrapping is like a stress test for financial modeling. It helps us see beyond the immediate numbers and understand the broader picture. It gives us a sense of how our models might behave in different scenarios, providing an avenue to refine and improve them. Bootstrapping isn't just a fancy statistical technique, it's a vital tool that gives us confidence in our financial models. It allows us to navigate the choppy waters of financial forecasting, giving us a firmer grasp on the tiller. With bootstrapping, financial analysts can ensure their models are robust and reliable. When it comes to investment analysis, bootstrapping is a valuable tool. It's sort of like having a crystal ball that gives you insights based on historical data. But instead of magic, it's solid statistical methodology. Now let's imagine you're an investor. You've got some capital to invest, but you're not quite sure where to put your money. You could go with your gut, sure, but wouldn't it be better to have some data-driven insights to back up your decisions? That's where bootstrapping comes in. Bootstrapping helps in estimating the return on an investment. It essentially involves creating thousands of sample data sets by resampling from the original data. These samples are then used to build a model that estimates future returns based on past performance. It's like creating a multitude of alternate universes, each with its own version of history, and seeing what happens in each one. This process allows you to create a distribution of possible outcomes rather than relying on a single estimate. It's like seeing all the paths a journey could take, rather than just one. This gives you a more comprehensive view of potential risks and rewards. It's important to remember that bootstrapping is not just about predicting the future. It also helps investors understand the volatility of an investment. By examining the range of possible outcomes, you can gauge the likelihood of extreme results, both good and bad. It's a way of understanding not just what could happen, but how likely different outcomes are. Let's take an example. Say you're considering investing in a tech startup. With bootstrapping, you can use the company's past performance to create a range of possible future scenarios. This might show you that while there's a chance of a high return, there's also a significant risk of loss. Armed with this information, you can make a more informed decision about whether to invest. By using bootstrapping in investment analysis, investors can make informed decisions about their investments. It's not a guarantee of future success, but it does provide a strong foundation for decision-making. And in the world of investing, having an edge, however slight, can make all the difference. While bootstrapping is a powerful tool in finance, it's not without its limitations. Let's take a look at some of these restrictions that might make this method less than ideal in certain circumstances. Firstly, bootstrapping heavily relies on historical data. It assumes that the past is an accurate reflection of the future. But, as we all know, history doesn't always repeat itself, especially in the financial world. Market dynamics can change, new competitors can emerge, and unforeseen events can drastically alter a company's financial trajectory. So, the assumption that future performance will mirror past performance can be a significant limitation. Moreover, bootstrapping doesn't account for external factors. It doesn't consider macroeconomic conditions or industry trends. It's a method that's primarily inward-looking, focusing on a company's own historical data. But in reality, a company's financial performance is also significantly influenced by external factors, which bootstrapping tends to overlook. Another limitation is that bootstrapping may not be accurate for every financial situation. For instance, it might not be suitable for startups or companies in fast-changing industries, where historical data is either limited or not reflective of future potential. In such cases, other financial analysis methods might be more appropriate and yield more accurate results. Furthermore, bootstrapping assumes a certain degree of stability in a company's financial performance. It works best when a company's revenues, costs, and other financial parameters are relatively stable and predictable. But if a company is experiencing high volatility in its financial performance, bootstrapping might not be the most accurate method for predicting future financial outcomes. Lastly, bootstrapping can be a complex and time-consuming process. It requires detailed historical data and sophisticated financial modeling skills. Not every company or investor has the resources or expertise to effectively implement this method. In conclusion, while bootstrapping can provide valuable insights into a company's financial future, it's important to keep its limitations in mind. It's not a magic crystal ball that can predict the future with absolute certainty. It's a tool, and like any tool, it's only as good as the person using it. Understanding the limitations of bootstrapping is crucial for its effective use in finance. Bootstrapping is a key concept in finance, used in everything from financial modeling to investment analysis. As we've seen throughout this video, it's a technique that allows us to create a theoretical spot rate curve, using only the prices of zero-coupon bonds. It's a powerful tool in financial modeling, aiding in the estimation of future financial performance based on historical data. Furthermore, in investment analysis, bootstrapping can help investors make better-informed decisions by generating a multitude of possible outcomes and calculating the likelihood of each. However, like any tool, it has its limitations. It's based on the assumption that past performance can predict future outcomes, which isn't always the case. Despite these limitations, bootstrapping remains a valuable concept in the world of finance, offering insights that might not be immediately apparent from raw data alone. Thank you for joining us on this deep dive into bootstrapping in finance. For more insightful videos on finance, don't forget to subscribe to Deep Dive into Finance channel.